Hi, my name's Sean Wright. I am a Pittsburgh-based IRS tax attorney, and I help people get out of tax trouble, and those people are usually owing large amounts to the IRS. Now, a certain number of my clients are good candidates to use a bankruptcy filing to get rid of their back taxes. There are some rules to follow, however, in order to discharge back taxes. And again, these taxes can only be income taxes. If you owe delinquent payroll tax, it's not dischargeable in bankruptcy court. So it's got to be income tax. So with the rules, first, these have to be for older tax years. Let's say you are filing your bankruptcy case on July 1st, 2017. You would not be able to wipe out income taxes owed in either 2016, 2015, or 2014. However, any taxes incurred in 2013 or in prior years, those could be dischargeable. So that's rule number one, must be for older tax years. Rule number two, your tax returns for those specific years have to have been filed at least 2 years prior to your bankruptcy case being filed. In other words, you have to be the one to have filed the returns, not the IRS. A lot of times the IRS will, if you have not filed a return approximately 2 years after the due date, they will go ahead and file what's called a substitute for return using their records to put something on the books. If the IRS has filed a substitute for return in your case for, let's say, 2010, then you're not going to be able to discharge 2010's tax debt. So we have to specifically go through the IRS records for each year that you're looking to discharge and see whether or not returns have been filed and assessed. Now, the third rule is that the tax assessment has to have been at least 240 days prior to the bankruptcy filing date, essentially 9 months. What's a tax assessment? A tax assessment is when the IRS puts the tax money on the books. In other words, let's say that I file my tax return on April 15th this year. The IRS will receive my tax return and process it, and they will assess the taxes usually about 6 to 8 weeks after I file my return. That means they agree with my return and they put that amount owed on their books, and now they start to collect on it. So the tax assessment has to have been done in a bankruptcy case situation at least 9 months prior to the bankruptcy case being filed. In other words, the courts do not want bankruptcy filers to suddenly file bankruptcy and ambush the IRS. They want to give the IRS a fair shot at being able to collect its tax debt and have the tax debts be aged. Now, there are certain things that you might have done in the past that would delay your filing from being ripe for bankruptcy filing. In other words, if you have filed a previous bankruptcy case, that may extend the time period in which you're going to become eligible to get your taxes discharged. Moreover, if you filed an offering compromise, that will extend the time period as well. So looking at whether or not you're eligible to file bankruptcy and discharge IRS taxes is a very detail-oriented task. I've got to obtain the IRS's records and carefully look through them and calculate the dates at which you're going to be eligible to file your case and thus wipe out the taxes for a given year. So it is a tool that works very, very well. Not everybody's going to be eligible. Not everybody's going to be a good candidate, but bankruptcy can be excellent as a way to get rid of back taxes. If you have any questions about this, give me a call, 412-920-6565. I'd like to hear from you. Thank you very much.